Have you ever noticed that every financial disaster starts with the same four words? Everyone knows this is safe? In 1999, every cocktail party conversation ended with someone bragging about their internet stocks. Day traders quit their jobs. Taxi drivers gave stock tips. Even your grandmother was buying shares of companies that had never turned a profit. Then March 2000 happened. The Nasdaq crashed 78%. Trillions vanished. The crowd that knew technology stocks only went up learned a brutal lesson about the cost of consensus. But here's what's fascinating. While millions were losing their life savings following the herd, a small group of investors were doing the exact opposite. They were buying when everyone else was selling. They were zigging when the world was zagging. They were contrarian investors, and they became extraordinarily wealthy. Today, I want to show you why being a contrarian isn't just an investment strategy. It's a survival skill. Because in a world where information travels at light speed and social media amplifies every emotion, following the crowd has become more dangerous than ever. Let me tell you about Howard Marks. You probably don't know his name, but you should. In 1990, when the savings and loan crisis had everyone running from real estate debt, Marks saw opportunity. While banks were selling distressed real estate loans at massive discounts just to get them off their books, Marks was buying. His colleagues thought he was crazy. The media called real estate a dead asset class. Financial advisors warned their clients to stay away from anything property-related. But Marks understood something the crowd didn't. He knew that when everyone agrees something is worthless, it's probably undervalued. Over the next decade, as the real estate market recovered, those distressed debt investments generated returns of over 30% annually. Marks built his firm, Oaktree Capital, into a $120 billion empire by consistently doing what felt uncomfortable. While others panicked, he calculated. While others followed, he questioned. This is the essence of contrarian investing. It's not about being different for the sake of being different. It's about understanding that markets are driven by human emotion, not mathematical precision. Think of the market like a pendulum. Most of the time, it swings between reasonable extremes. But occasionally, driven by fear or greed, it swings far beyond what makes sense. When everyone is euphoric, prices get pushed too high. When everyone is terrified, prices get pushed too low. The contrarian investor waits for these extreme swings. They buy when the pendulum is at maximum fear. They sell when it's at maximum greed. It sounds simple, but it requires something most people don't have: the ability to act against their own instincts. Here's a data point that will shock you. According to research by Dalbar, the average investor earns just 2.6% annually over a 30-year period. Meanwhile, the S&P 500 averaged 10.5% over the same time frame. Why the massive gap? Because the average investor buys high and sells low. They get excited when markets are soaring and buy at the top. They get scared when markets crash and sell at the bottom. They follow their emotions, which means they follow the crowd, which means they consistently make the wrong moves at the worst times. Your brain is hardwired for this failure. We evolved in small tribes where fitting in meant survival. Standing out could get you killed. So we developed powerful instincts to follow the group, to do what everyone else is doing. But in investing, these survival instincts become wealth destroyers. The very psychology that kept our ancestors alive is what keeps their descendants broke. Let me share another story that illustrates this perfectly. In 1974, Warren Buffett was writing his annual letter to Berkshire Hathaway shareholders. The stock market had crashed. Inflation was raging. President Nixon had resigned. The country felt like it was falling apart. Most investors were selling everything and hiding in cash. Financial magazines ran cover stories about the death of equities. The conventional wisdom was clear. Stocks were finished. But in his letter, Buffett wrote something remarkable. He said that he felt like a mosquito in a nudist colony. He knew what to do, but he didn't know where to start. There were so many incredible businesses trading at ridiculous prices that he couldn't buy them fast enough. While everyone else saw danger, Buffett saw opportunity. He bought shares in companies like the Washington Post for a fraction of their intrinsic value. He purchased stakes in businesses that would compound wealth for decades to come. Those investments, made when everyone else was running for the exits, became the foundation of his fortune. Today, Berkshire Hathaway is worth over $700 billion. Buffett didn't get rich by following the crowd. He got rich by having the courage to stand against it. But here's what makes contrarian investing so difficult. It doesn't just require going against the market. It requires going against yourself. When stocks are crashing and financial headlines are screaming about catastrophe, every fiber of your being will tell you to sell. When markets are soaring and everyone is getting rich, every instinct will tell you to buy more. The contrarian investor learns to interpret these feelings differently. When they feel the urge to sell, they know it might be time to buy. When they feel the urge to buy, they know it might be time to sell. They use their emotions as a reverse indicator. Think of it like driving in fog. When visibility is low and you can't see the road ahead, your instinct is to speed up, to get through the dangerous area as quickly as possible. But experienced drivers know to do the opposite. They slow down. They proceed with caution. They wait for the fog to clear. Contrarian investors treat market volatility the same way. When uncertainty is high and the path forward is unclear, they don't panic. They don't rush. They use the confusion as an opportunity to buy quality assets at discounted prices. This brings me to the most important insight about contrarian investing. It's not really about predicting what will happen next. It's about recognizing when prices have become disconnected from reality. When a dollar bill is trading for 50 cents, you don't need to know when it will return to $1. You just need to recognize that 50 cents is the wrong price. The market will eventually correct itself, but you don't need to time when. This is why contrarian investing works so well with a long-term mindset. You're not trying to catch falling knives or time market tops. You're simply buying assets when they're unloved and holding them until they return to fair value. The wealthy understand this. They know that true contrarian investing isn't about being smarter than everyone else. It's about being more patient than everyone else. It's about having the emotional discipline to act rationally when others are acting emotionally. So how do you develop this discipline? Start by questioning consensus. When everyone agrees that something is obviously true, ask yourself, what might be wrong with that assumption? When financial media is unanimous in their predictions, consider the opposite scenario. Pay attention to your own emotions. When you feel absolutely certain about an investment decision, that's when you should be most cautious. When you feel terrified to make a move, that might be when opportunity is greatest. Remember, in investing, comfort is expensive and discomfort is profitable. The crowd will always be wrong at the extremes because the crowd is driven by emotion, not logic. But you can choose to be different. You can choose to think when others feel, to calculate when others panic, to buy when others sell. The next time everyone agrees that something is obviously true in the markets, remember this: consensus is the enemy of exceptional returns.